Hi guys, this is Charlie from The Savvy Professor. In today's video, I will discuss the differences between FIFO and LIFO. Watch until the end to know the final verdict on how they compare, but first, let's start with the differences. So the main difference between them is the inventory flow. FIFO assumes that the first item added to the inventory is sold first. Most companies prefer FIFO as a logical choice since it reflects the current market prices better. In contrast, LIFO assumes that you sold the most recent item on your inventory first. Consequently, the oldest item on your inventory is left over at the end of the accounting period. Some companies prefer this method as it matches the present cost with the revenue. Therefore, older inventory flows out faster with FIFO than with LIFO. Effect of inflation. When you record sales using FIFO, you sell the oldest inventory first, leaving the newer and more expensive ones in stock. During inflation, FIFO could result in a higher net income because the older, cheaper inventory would be sold at the current cost of goods. Conversely, recording sales using LIFO means you'll sell the most recent items on your inventory first. During an inflation, this decision could result in lower profits. Therefore, FIFO promises greater returns during inflation. Financial reporting. GAAP and IFRS users generally accept FIFO as a viable financial reporting method because this method ensures items don't remain in the books for too long. Remember, with FIFO, the oldest items are sold first, which ensures continuity. In contrast, IFRS doesn't support LIFO because of the backlog it creates. The IFRS applies to companies outside the US. This restriction reduces the flexibility in financial reporting methods for these companies. Therefore, FIFO offers greater flexibility on how companies report finances. But do they have any similarities? Yes, both methods rely on a predefined order to add and remove items. But they're also accepted among US-based companies since they're supported under the generally acceptable accounting principles. To sum up, how do they compare? FIFO and LIFO. FIFO creates greater flexibility when reporting your business's finances. It also comes in handy during inflation due to the higher profits. Furthermore, FIFO logically organizes your records, making it ideal for most companies. On the other hand, LIFO is perfect for reducing tax liability since it doesn't match your inventory's physical movement. Consequently, both are decent options for any business. Thanks for watching.